Hi, it's Griggs of Obsidian Wisdom. Today we answer the question, where are three places to invest your money after you retire? For many of us, we know as we are working our way to retirement, we have usually growth-minded investments. We know that we have enough time, normally over 5 years, to where we can invest in assets that maybe have a little bit more risk than we'll be comfortable with in retirement. So sometimes what we end up doing is we take all of our money out of the stock market. And I'm thinking right now, that is not going to be the best approach. You do still want to keep up with inflation. If you don't keep up with inflation, then you already know that means that you're taking a loss every single year. If inflation is at 3%, that means you have to at least make 3% for you to have the same value in your portfolio going year for year. Now, for many people, they'll say, well, Dre, I mean, what is 3%? That's actually not that much. And while it may not feel like a lot in any one given year, there is something called the rule of 17, which is a very fancy way of saying that if inflation is about 3%, then every 17 years you have cut your purchasing power in half. And all that means is if your current retirement lifestyle required $100,000 per year to maintain it, then in 17 years, about 2 decades, you would need $200,000 to maintain the same retirement lifestyle. As a result, the three investments I normally recommend for people should at a minimum keep up with inflation when you put it all together. The first one is dividend-paying stocks. So there are a couple benefits, and I'll put a link to another video where I talk about some of the benefits of dividend stocks. But dividend stocks are nice to have in retirement for a couple of reasons. One is you're getting paid as a silent partner of the business. You getting a dividend from the profits of the company is the same as if you invested in a company and they said, hey, we'll send you a check every single month for your money. And we really appreciate that. You and I would say that's a great idea. I love that. I like dividends because for the most part, they tend to be blue chip companies. Blue chips is a very fancy way of saying these are stable companies that have been around for a while. And because they've been around, we don't feel they're going to have as much volatility. And we also don't feel there's as much of a risk of this company disappearing completely off the face of the earth. Now, it's not to say that it couldn't happen because we know during the Great Recession of 2008, there were some blue chip companies that completely disappeared. They were never the same again. They either sold off the assets, they were bought by a different bank, different things happened. And so we are aware it's possible, but it's highly unlikely that a Fortune 500 company is going to disappear. Another reason I like blue chip stocks is because it puts you in the mind frame of a value investor. If you guys are familiar with the likes of Warren Buffett or Ben Graham and different people as they talk about value investing, when you look at blue chip companies, you're basically investing in a company that already is successful. And I like the sound of that. These companies are already successful. They're already generating the money. We're going to look at their financials and we're going to see how they manage their money on an annual basis. That will give us an insight into how well the management team operates this company. And if we feel good about the direction of the company, then we can invest in it. After you retire, we're not as focused about hitting home runs and growth investments because growth investments haven't always proven that they're going to be successful companies. We're getting in sometimes at the ground level, sometimes in the early 1, 2, 5 years. And we believe that this company is going to turn it around. They're going to figure it out. They're going to change the industry. And so as a result, we're investing in these growth investments to ride that increase. But after retirement, the amount of risk that you would find in a growth-oriented investment allocation is probably too much risk for the average person. Now, if you're someone who has the free time and you like reading about these stocks like I do, then of course you can put a portfolio together that is growth-oriented, where you have certain parameters that will help you keep everything straight. You'll have the guardrails to ensure that you don't get shiny object syndrome. But for the average person, I do believe after you retire, focusing on value-oriented stocks where you're looking at the free cash flow, you're looking at the price to earnings ratio, you're looking at the price to earnings to growth ratio, you're looking at the price to book value and the debt to equity ratio. Now, I'll make another video where I go over what each of these ratios are and how you can use them to put your own investment portfolio together. These are going to be value investor oriented numbers that you would be looking at to find out, is this company a successful company today? Now, when it comes to the average return that you could be looking for from your dividend paying stocks, we're normally looking about a 7 to 10% return when you're investing in the stock market. Now, depending on how stable the companies that you're investing in are, that may not be the number you get. You may not get the 7 to 10%, maybe somewhere in that 3 to 6%, but you're still at least keeping up with inflation. And then if you're withdrawing your money on the 4% rule, where you're probably going to be able to maintain that, where you're probably exceeding that 4%. So even though you're taking 4% out every year, you may be making 5 or 6% every single year in your investments. And as a result, your portfolio is actually growing in your retirement. Number two is bonds and fixed income. For many people, the idea of retiring and leaving your money in the stock market keeps them up at night. And a part of your investment strategy is making sure that you understand your own personal risk tolerance And then you're able to put a portfolio together that makes sense for you. And there is no benefit in creating a portfolio that isn't aligned with your risk tolerance because you think you're going to be able to maintain it. Because I'm telling you, as soon as you have one of those down years where you maybe have a little bit more risk than you were ready for, and as a result, maybe your portfolio loses 10%, you're going to sell everything at the absolute bottom, which means you're locking in your losses. And so, depending on your own personal risk tolerance, it may make sense for you after your retirement to focus your investments on bonds and fixed income assets. When you're talking about bonds, what you're doing is you're taking on the debt of a company. So, again, you still want to have a stellar company. You don't want to take debt of a company that's not going to be here in 5 years because then the paying you back isn't going to be worth anything. You want to make sure that the company at least is going to be here as long as the debt that you have and the payments that you're getting. So you want to still invest in relatively safe companies when it comes to that. As a result, you can be looking at a return somewhere usually around maybe like 2 to 4% in the current market. I've seen some as high as 5 or 6%, but it's unlikely that you'd be able to maintain that in your entire retirement. So to play it safe, you'd probably want to go ahead and say, you know what, let me just go ahead and expect to be somewhere in that 2 to 4%. And then let's put a plan together where I can see how much I expect to get on my returns. Now, I would tell most people, even if you're not very comfortable with investing in the stock market, if you have a solely bond focused investment portfolio, you're really teetering on your ability to outpace inflation. And we've already talked about the risk of that. Now, for those that don't know, or maybe you know and just want a reminder, when you're talking about a bond, you're taking the debt of a company. As a result, you don't get to take advantage of any of the upside of being a business owner. So let's say with Obsidian Wisdom, you have the ability to invest $100 and take stock in the company. Well, that means any year that we exceed expectations, we have an amazing year that increases the amount of money that you would get as a business owner who has stock in the company. You are a silent partner. You're a business owner. Versus if you just took bonds and took debt from me, that would be the same as if you took out a mortgage or a car payment. It has a set amount that you're going to get paid every single month or every single year, whatever those interest payments are. It has a set term. So let's say you took $100 of debt of Obsidian Wisdom, and I said, all right, I promise to pay you $5 a month for the next 6 months. Well, that's what you're going to get. Whether I make poor management decisions and the company barely can stay afloat, you still get that same $5 every single month. Versus if I win a Nobel Prize and the company grows by 1,000-fold, you still are only going to get the $5 a month. Now, for many people, that is a safe and comfortable approach where a lot of people will be comfortable in retirement. But for others, if you're investing in good companies already, then it sometimes doesn't feel quite the same, where this company is growing significantly based on the money I loaned them, and they're only giving me $5 a month for 6 months. But they took that $100 and turned it into $100,000. And if I did take $100 in stock versus the bond, then I would get to participate in that growth where the company, the stock has increased significantly because the company is worth more. So obviously the stock price reflects that. Again, that is going to come down to you and your own personal investment philosophy. But for most people who are uncomfortable being 100% invested in the stock market after retirement, it's a nice blend to have inside of your portfolio where you have some of your money safe and then you have some of your money that has the ability to still grow. And you're not trying to hit home runs looking for venture capital and growth oriented stocks, but you are finding solid companies who are already very successful and you're generally looking for them at some sort of a discount where you're able to take advantage of some of the growth because you bought the stock at a discount, but you're not overexposing yourself to the risk of the stock market in general. Now, obviously, there's still risk, just like we're talking about dividend traps. There is value traps where there's companies that have a very low price to earnings ratio, and it might be because the company is distressed, where the company is about to go under. And even though they're at a great price, they're never actually going to appreciate back to that value, that the earnings are just going to continue dropping until the company is completely gone. Now, the third and final place to invest your money after retirement would be your real estate investment trust. Now, I like these because it sort of gives you a little bit of the benefits of both of them. It's not quite investing in stocks. It's not quite investing in bonds. It's its own sort of area. And I do like it as far as places to put your money after you've retired. Heck, I like it as places to put your money before you retire. Some of the benefits of real estate investment trust is you're already invested in very solid companies. So we're still kind of taking that value investor approach. These are amazing companies who have a portfolio of businesses, real estate in particular, and they're either focusing on getting the mortgage payment because they gave out the loans and then they're receiving the mortgage payments each month with the interest on top of it. Or they may be rental companies that are more focused on renting out things. So you can invest in a REIT that has huge business complexes where there's massive companies paying significant rent every single month. You can invest in REITs that are focused on apartment complexes where you and I would say, yeah, it would be great to have a 200, 500 unit apartment where everybody's paying rent to me. But how would I get the money to be able to do that? Well, if you invested in an already established and successful real estate company that is looking for the revenue, well, now you can invest in those opportunities that you and I would say I would take advantage of that if anyone ever knocked on my door. I just don't have enough money for me to be offered this. Well, this would be your chance to be able to take advantage of that. REITs give you the chance to partner with some very amazing real estate companies. Now, obviously, all of them aren't that amazing, but many of them are, because while REITs are required to pass on 90% of the income to the investors to maintain their favorable tax structure, the operational cost of the REIT that is subtracted from the income may be unreasonable, where the people are paying themselves a lot and they're not really providing that much value when it comes to the overall performance of the portfolio. So you do want to keep an eye on how much the company is paying itself and how much it's saying is its operational cost. Now, when it comes to return of a REIT, they're normally in the 8 to 12%. So when you look at the appreciation of the REIT with the dividend that it pays back, now granted, it's worth mentioning that the dividend inside of a REIT, because they're normally higher than the average dividend, so the average dividend yield is going to be about 1.5%, but I can find you some REITs that are 5 to 10%. And as a result, because REITs have such a high dividend yield, which indicates how much money you as the investor receives, normally the dividend from the REIT is going to be taxed as ordinary income. So it's just another wrinkle that you want to keep in mind. But when you're looking at the idea of where I'm going to put my money after retirement, I believe these three strategies will work very well for you. Now, depending on your risk tolerance, if you're someone who is very risk averse, you may have 50% of your money in bonds, and then you may have 30% in REITs, and you may have 20% in the stock market. If you're someone who feels relatively comfortable with the investments in the stock market because you are taking a value approach where you're basically hedging some of the risks that we take when we're investing in companies that maybe haven't proven themselves yet. And in that case, we would flip the numbers around where you'd have 50% of your money in the stock market, you'd have 30% in the REIT, and then you have 20% in the bonds and the fixed income assets. Depending on your overall risk tolerance, you can kind of play with the numbers here and there. You may say, you know what, Dre, I don't feel very strongly about any of them. I think I'm okay doing a third of my portfolio that is invested in stocks, I have a third of my portfolio in REITs, I have a third of my portfolio in bonds and fixed income. And then based on the average returns that I gave you earlier, you can expect each of these portfolios to range somewhere about 5.5 to 7.5%, which means you would be able to outpace inflation with any of them. So if your portfolio was 30% REITs, 50% bonds, and 20% stocks, you can expect to have about a 5.5, 5.6% return based off of what we just mentioned as far as the average returns. If your portfolio was 50% stocks, 20% bonds, and 30% REIT, then you can expect to have a 7.5% return on average based on what we said would be the average return that you would have in each of those asset classes. And then if you split it evenly between all three of them, where you had a third in real estate, a third in bonds, and a third in the stock market, you can expect to have just under 7% with a 6.7% return on average. Now, again, these returns are on average, where you could find yourself with a 17% return one year, and you could find yourself with a minus 3% return the next year. It is a historical average, which is why it's very important that you choose the portfolio not necessarily based on the return that you're going to get, but based on your ability to maintain the discipline of the investment strategy, where you don't invest beyond your risk tolerance because you're going to make poor investment decisions if you do. Let me take a moment to thank you for watching this video. I always appreciate your time. I do not take it for granted. If you found value in this video, go ahead and like and subscribe so you can continue receiving valuable insight on how to stop worrying about money and start enjoying your retirement. Until next time, stay safe and enjoy life.